Good afternoon, dear traders. This is Alex Gerchik, the president of the company Gerchik Co Company, and today is it's going to be a webinar about what kind of analysis to choose for trading, what to choose: day trading, swing trading, fundamental trading, long-term trading, forex, stock market, or anything else. So basically, it's a very important thing what to choose. As usual, I will probably begin with a story about myself. As I said, next year it's going to be 20 years that I've been in trading. I will tell you how did I begin. I began purely as a day trader because, when I started the company, the name of the company was WorldCo. We used to do a pure day trading. We had nothing else, just a day trading. Buy and sell during the day, 3:55 p.m. New York time, all position must be closed. It does not really matter, you're in profit, you're in loss, but it doesn't really matter. 3:55, you have to close all the position. That was the politics of the company. But probably 2 or 3 years later, once I started to make good money, and I hold a very large sum of my personal money in my trading account in my firm, I start to held the position overnight. Usually, a lot of times when you have a position, an intraday and a stock closed, for example, in your favorite, for example, let's say below moving average or below low of the year or low of the day or low of 3 months or anything else, in any significant historical moments, you can basically hold the position overnight. So in 2001, 3 years in trading, I started to hold the positions overnight. For example, I trade, and at the end of the day, I see the S&P closing lower, NASDAQ closing lower, Russell 2000 closing lower, and I was basically just trying to hold a position on overnight. Next day or day after or 3 days after, I would cover the position. Unfortunately, when it was a September 11, I was in shorts, and I did make a lot of money, and at that period of time, I wasn't too happy by making that kind of money, but what I figured out that if the big position accumulated by the shorts or big position accumulated by the long, they will take the price lower or higher. So what I figured out, if the stock is basically during the day goes totally different way from the S&P, for example, S&P is going up and the stock is going down, it goes with on life, I would definitely short the stock, and if the stock is closed, let's say below moving average or below any particular price, which has a historical movement, I would definitely short that particular stock to the next day. Then I see the way the stock is going to open, and definitely would make a decision what to do next. These days, me and a few of my friends who used to trade with together, we have a combination of 2 different styles. We use the fundamentals and we use intraday trading. Just for you to understand, pretty much almost every single day, I make this kind of list or this kind of list where I prepare myself. You see with the stocks, I put the price, directions, so you can take a look in a lot of stocks. This list was prepared on October 10. I take the positions overnight and I hold with the stocks and I see what the stocks are doing. Most of the time, I will not look for the fundamentals, but if I'm trying to take a large position, I would definitely look for the fundamentals. A lot of times, every trader try to figure it out the way what to choose for trading. I mean, what to trade. Fundamentals or anything else. Just for you to understand, every single market has its own advantages and disadvantages. Let's begin with the, let's say, forex market, then we'll go to the stock market, and then to Chicago Mercantile Exchange, or let's say English market, England market, or German market. It does not really make a difference because the chart and the fundamentals are pretty much the same everywhere. So, for example, if you're a forex trader, very important thing for you as a forex trader is to figure it out what you want to trade. Just for you to understand, the forex market has a few advantages and a few disadvantages. The disadvantage of the forex market is the volatility. The volatility is not that big. Stock market obviously does give you a bigger volatility, but in a forex market, there is a very good advantage, is the range. Usually, as you know, all forex trading, for example, if you trade euro or trade British pound, they trade in range, and in range sometimes it's much easier to make money than in trend. I'll tell you why. A lot of people would say that I'm completely out of my mind, but trust me, I'm not. When you trade trend, you always have a problem. You know, if you enter into the trend, not, let's say, for example, in a position where the trade is flat, then you're definitely going to have an issue, and the issue is going to be because the stock, for example, or the pair is moving, and you cannot buy it because you're going to have a very big stop. Usually, the smaller stop you always have if you trade from levels. If you trade with the range, then you're going to definitely have a small stops because you know where to attach that particular stop. But if you trade movement, then you definitely can have an issue. So when you trade forex market, you have to figure it out. Is it enough for you to get out of, for example, currency, for example, range? Let's put it this way. If we will take euro, average trade in euro, average move in euro, ATR, is about 85, 90 points. So euro trading right now 1.05. So we're talking about 0.75% average ATR during the day. If, for example, you got somewhere inside the move, so somewhere in the middle of the range, you're going to be only able to trade less than 0.5%. So, for example, if you stop, let's say, 20 points, and your average move is, let's say, 50, you hardly can enter that particular trade intraday. So, what do we have? If you trade forex, most of the time, you're probably either trading with a very small stop or with a very big range. Or if you're going to trade forex, you can definitely take a position overnight. For example, if you trade stock market, you're definitely going to be able to trade a lot of stocks which has a very large move. Today, I just want to show you something. I'll open right now a filter so you figure it out where the stock market trades and what's so good about it, or obviously what's so bad about it. So hold on just 1 second. Okay, percentage losers. All right. Okay, hold on just 1 second. I'm getting almost ready. All right, just hold on 1 second. I will show you. Okay, that's what we see right here. This is just the second part of my screen, and what do we have right here? This is the stocks which basically moved today, and as you can see, just the first page is about 50 or 60 stocks. Everybody is down more than 3% at least. So, for example, we have this particular stock, BPT, which is down today almost 18%. In 2 days, as you can see, the stock is down from $30 a share to $20 a share. Right, so 10 points. The stock is down almost 35% in a few days. This particular stock, take a look, ZOES. Stock is also down today 11%. HCLP open with a gap down 11%. PMC and HP or JCPenney, take a look. All of the stocks, they are down big. So what you can figure it out, that there's a lot of different stocks which is down more than 5, 7, or 10%. But very important issue with this particular stocks, you gotta go through a lot of different companies during the day in order to figure it out which one is going to be up or down. Take a look, let's say upside. Also, there's a lot of stocks that are up. For example, this particular stock is up 22%. This particular stock is up 12%. RLGY is up almost 8%. So there's a bunch of stocks that you have. Take a look, which is up over 2, 3, 4%, 5%, 9%. So in this particular case scenario, we just look at New York stock. Then we have Nasdaq stocks. Also, take a look, up 35%. This particular company, take a look. CEMP is up 35%. IPCI, take a look, is up 30%. AAOI up 22%. Take a look. OLED is up 20%. AXDX is up 60%. So you have a bunch of different stocks which are up more than 10 or 20%. So I wanted to tell you one thing. I will show you right now, at least where sometime I do a fundamental analysis. Right here, I use this particular website. It's called Finviz. In this particular website, you can basically choose a lot of stocks with a good or bad fundamentals. All you have to do is just gotta go with the screener, take a look. And with the screener, you can figure it out. You see, you can analyze any stock for free. Do you own the right stock? You can analyze the stock for free and figure it out as a good company, bad company. So in this particular stock, you can lose the fundamental. For example, there's obviously 8,000 stocks. So for example, we'll try to figure it out. Some stock which has a bad fundamental. So let's say we're going to analyze USA stocks with industry. We're going to take only stocks, no ETFs. So right now we already came out to almost 4,000 stocks. Obviously, if we want to trade, the stocks which has a decent average volume. So we're going to trade the stocks with a decent average volume. Let's say we're 300,000. So right here we have 1,800 stocks. Then definitely we can go to the fundamental. We can figure it out. Take a look. Earnings per share grows in the next 5 years. You can have negative. So you see the company losing money. For example, let's say we're going to take it a negative. There's over 100 companies, you see, which has a negative earnings per share. And this particular company is right here. It's almost 100 stocks, which has a negative growth. So you can take a look. You see, obviously something is not that bad at this particular stock if the stock is not dying. So market cap is over $2.3 billion. Earnings per share basically drop in the next 5 years, but there's a gross margin, a huge with this particular company. Not a lot of shares outstanding, but you gotta go more deep into details to see. Most likely the company pay dividends. Let's see, no, they don't pay dividends. Book value is pretty low towards what the stock trading. So in this particular things, you can figure it out what's going on with this particular stocks, why they're moving down, why they're moving up. Let's say AMAG, take a look, the stock is getting bidden up. The earnings per share with this particular stock is much lower, but you have to see what's going on. So what I wanted to bring you, before you start to trade, you have to figure it out what exactly you want to trade. If, for example, you want to trade fundamentals, my advice to you, the fundamentals have one simple issue. If you want to trade the fundamentals, you have to, let's say, buy and hold, for example, for a very long time. If you buy the stock, you have to sit on it. If you sell the stock, you have to sit on it. But you should understand one thing, that every single stock has the volatility, and the volatility can be good or volatility can be bad. What's good or bad about the volatility? For example, if you're a trader, the volatility actually is good for you. For example, you try to buy low, the volatility is huge, and you try to sell high. If the volatility is very low for you, you cannot make too much money. But if you trade fundamentals, for example, and according to the fundamentals, the volatility is very big, you definitely going to eat that particular volatility. You should understand. Let's take one of the stock, and I will show you and explain what do I mean. Let's see. Okay, we just took a random stock, AXDX. Stock is up today, let's say 25, 20, almost 25%. We see the volatility here, right here, from 28 to $19 a share. The stock went down 9 points. It's almost 35%. Then we went up 35%. Just for you to understand, this is the volatility of the stock, and the volatility is pretty big. For example, if you got in the wrong side of the page, you can definitely have a bad volatility, and you for sure is going to have a problem. What kind of problem you're going to have? You're going to have a problem of, if, for example, take a look, everything was fine with the stock. You buying the stock at $26 a share, everything is fine. Take a look. It's so beautiful. Stock more than double, almost triple. Everything is fine. You're buying the volatility, and then that's the bad volatility. You have to eat this. So, for example, if you got long and something went wrong and you even believe into the company in a big way, you buy in the stock, you assume the volatility of 30%. Obviously, you know, sooner or later, I mean 6 months later, you get in your money back. But what if the stock is going to go down? For example, I will show you this particular company. Take a look, CXRX. Take a look. If for example, you buy somewhere here, everything looks fine, you know the stock is not going lower, but take a look what's going on later. Take a look. You see? Right now the stock is close $2 and it's dead. So for example, if you believe still in the volatility, I mean in the fundamental of the company, you're going to eat all of this volatility, you can lose 90%. So I usually don't like the word of advice, but in this particular case scenario, this particular webinar, I would tell you my advice. If you try to trade the fundamentals, make sure you're going to trade fundamentals together with the technical analysis. So for example, as I said before, if you take a look at my list, I have a list of stock that I trade in a technical way, but most likely I use the fundamentals. If the fundamentals is good, I would only short the stock to the particular moment. And if basically the fundamentals are bad, I would definitely buy only if there is, for example, a very good scenario to buy that particular company. But most of the time, my advice to you is to use technical analysis together with the fundamental. A lot of times the traders asking the way I trade. And as I said before, we'll go to every single scenario. If you want to trade forex, you should understand one thing. Most of the time, you got to use a swing for one simple reason, because the volatility of forex is not that big. And 0.6, 0.7% a day, you got to use stops. And sometimes your stop, it's not enough to get all the volatility. If you trade United States stocks, you definitely have a huge volatility. You can make a lot of money, but the major problem that you have to go through a lot of different stocks. If you trade Chicago Mercantile Exchange, then you definitely have to have a decent account and trade with a lot of long and big stops. Because just for you to understand, if you trade gold, the average stop in gold is almost $2.5, $3, and it's about $300 on one contract of gold. Oil probably will run you between $150 to $200 per stop. So if you trade Chicago Mercantile Exchange, you have to have enough money in order to survive that particular stop. If you trade, for example, England market, then you have to deal with the stamp tax. So on every single trade, you have to pay stamp tax. If you trade Germans, that's the one thing, the volatility of the DAX is huge. If you trade French market, you should understand there's a lot of times shorts are not allowed. So when you choose a particular instrument or particular market, you have to figure it out what exactly you want from that particular market. For example, I trade US market and trade forex. I trade forex on levels, and you follow me, but only if I understand in what particular stage the forex market is trading. Anyway, before choosing the market, before choosing the time frame, before choosing the instruments, you have to analyze everything and make sure you do understand what scenario you will particularly trade. If you have any question, you know what to do, write me and I'll be more than happy to answer all of your questions. Thank you very much. It's been Alexander Gerchik, and good luck in trading.